Ever since the pandemic lows and the GameStop rave, in which AMC stock participated in, price has just been in a straight decline from the all-time highs back in June of 2021 when price almost hit $400. Now the good part is that management took advantage of the price action when they sold stock to raise funds, to pay down debt, to operate the business. The bad news is that they did it at the expenses of the retail investor. Ever since the pandemic and once the economy opened back up, AMC's business model has been broken. And I don't see any way of fixing it. Now, before we look at the weekly chart, let me prove my point. So this article is coming from Investor Place. Citigroup just slashed its price target on AMC. It's been a terrible 2024 thus far. Stock is off 30%. Reason being, they keep selling shares primarily. The downgrades from analysts on Wall Street don't help. So Citigroup cut its AMC stock price target to $4.10 from $5.75 while maintaining its sell rating. This comes after Citigroup lowered its price target to $4.75 from $15.50 in September. I don't know why and how they would justify a plus $10 price target. Nevertheless, and then raised the target back up to $5.75 in November. This might have been when they did their reverse stock split. On December 11th, AMC announced that it had completed a $350 million at the market offering by selling 48 million shares at an average price of $7.29. The company then turned around and repurchased debt or exchanged debt for equity, resulting in a liabilities reduction of $62 million. Again, paying down debt, which is not bad. However, the dilution didn't end there. On the very next day, AMC disclosed that it had issued 1.56 million shares in exchange for 12.28 million in principal amounts of its notes due 2026. The exchange was part of a privately negotiated exchange agreement with a lender. AMC warned that it may engage in similar transactions in the future, but is under no obligation to do so. AMC has a hefty debt pile, which has been gradually reduced over the past few years. However, its debt still total $4.8 billion as of the third quarter. It's clear that reducing debt is a top priority for the company, although it may come at the expense of shareholders. Key word or words, expense of shareholders. All right. So this is the weekly chart, and price couldn't get back up to the weekly sellers level at $13. Would have been an awesome opportunity to short the stock. Could also short the stock during the break of this short-term uptrend. You have price basing back in late 2023 before the next leg down. You had a leg out of this range-bound price action. Another basin. Could have took the break out to the downside below $6. This wick over wick was another level of interest. On a smaller time frame, that is another basing opportunity before the next leg down. Now, to end the week, you do have this hammer candle, which signifies at least a current low has been placed into the stock. You have this drop in price, a basic candle, and a rally out. So at a minimum, I would anticipate price to test the lows at $4. If price is going to go higher over the short to medium term, it's going to form a W pattern. With a target at the $5.20. However, based on the fundamentals, I do think price is going to make a lower low. Based on the fundamentals. Based on sentiment, this double bottom before it moves higher could play out. We are in February. In a couple of months, we will be approaching summertime. However, remember the strikes of last year in Hollywood? That's going to impact this year's theater sales. So, what do you think is going to happen? We're going to see a double bottom and the price move higher, or are we going to see the next leg down? If that was a bet, man, I'm going to lean on the next leg down. Thanks for watching. Subscribe. Please like the video.